Trading is not easy. It is the most challenging things that you can do, but it can be very, very rewarding if you're good at it. Because at the end of the day, you're either right or wrong. There's nothing in between. The single biggest challenge that I see with traders every day is
Welcome to Make Your Move, the podcast that values insight over immediacy. Now, this is the first episode. I have a really special guest, Zoran Kresovic, who's the global head of premium client services at Blueberry. Great to be with you. Thanks for joining us.
Thank you for having me, Peter.
Yeah, no, it's great to have you, and it's a really interesting time in markets. It's a time where there's so much going on. Before we get into the markets and kind of some of the trades that you're liking at the moment, I just want to pick out kind of your background and how you got into markets and, what was the trigger that got you into trading?
I started quite early, probably at the worst possible time, and I'm sure new generations wouldn't even remember during the GFC, so 2007, 2008 global financial crisis. A friend of mine introduced me to the share market at the time. He came just like me back in late 90s from Serbia. We came as refugees, and he somehow found his way into the share market and was doing quite well up until that point. And I showed an interest in it. I was in banking at the time, and I got stuck in, and the rest is the history.
So you got in through shares?
Correct. Yeah. So I started through shares, and obviously, it's a challenge as you start out. You don't know what you're doing or where you're going. So it was a lot of dabbling in the financial markets early on, especially for the first couple of years. Markets were very turbulent at the time. And then I realized if I want to take this more seriously, I got to get some education under my belt.
That was a really interesting time because share trading went from your traditional stockbroker to online during the dot-com boom, but we hadn't yet had this very big opening up of global markets, different indices being able to be traded, derivatives. How did your style shape as these new tools came to market?
Definitely. I mean, over the years, I grasped a lot more experience in the market, and, brokers and technology side of things improved as well over the years. So I dabbled and found my niche markets that I like to trade. Initially, it was a little bit more, I'd say probably slow and conservative. I was just using one of those brokers like a ComSec or Westpac to trade shares, physical shares. And then as I gained more momentum and experience, and as you said, more markets opened up, index markets and commodity markets, I actually started dabbling into that and learning my craft. That obviously came with a lot of work and effort, a lot of education, a lot of mistakes, a lot of learning curves. But here we are, nearly 20 years after, and I'm still in the market.
Quick pause before we dive into this episode, brought to you by Blueberry, the online trading platform built for pro traders. Whether you're diving into gold, riding momentum in indices, or fading the Dixie, precision's everything. That's why Blueberry's razor-sharp spreads and millisecond execution speeds means you're positioned when you're ready to execute. You can choose from 6 powerful platforms: TradingView, MetaTrader 4, MetaTrader 5, CTrader, Blueberry X, and social trading. Pricing is transparent, funding is streamlined, and withdrawals are instant. Everything managed through a clean client portal with real 24/7 support via chat or phone when you need it. Thousands of traders worldwide are already trading with Blueberry. So when you're ready to make your move, make it with the broker that moves with you. Learn more at blueberrymarkets.com. That's blueberrymarkets.com.
This podcast contains the ideas and opinions of its author and is distributed on the understanding that Make Your Move is not rendering investment, financial, legal, accountant, or tax advice. The ideas outlined may not be suited to your financial circumstances, and therefore you should get financial advice from a competent professional. The author specifically disclaims any responsibility for any liability, loss or risk, personal or otherwise, which is incurred as a consequence of the use and application of the information outlined below.
Okay, so the big one, Zoran, what's been the biggest trading mistake or the thing you've regretted the most, but also something that you've learned from?
The biggest mistake that I've made through my initial learning stages when I was learning how to trade financial markets was falling in love with a particular stock. That's an absolute no-no.
Stocks can do that to you, right? Because, stocks have CEOs, they have companies, they have websites, they have real businesses, and you can get really sucked in to believing something that isn't true.
Absolutely. And to that point, I've actually seen my friend make quite a big money on that particular stock over a 2-day period, which was a pure luck. There was no knowledge absolutely involved in any of that. And I think we all fell in love with that stock. And we religiously started following it through, and we thought, the announcements, the fundamentals of the stock, there was a lot more upside. It was one of those Cinderella stories that penny stock from, 5-10 cents will go to $10, $20. Unfortunately, I learned the hard way with the hard landing. That wasn't the case. However, what it did teach me was to get properly involved and seriously take this on board and start getting educated.
And I think a lot of stock investors go through a similar experience, and they then mature to other markets or other indices. Like, you're not going to fall in love with a 10-year treasury yield, right? You're not going to fall in love with the Aussie dollar or a pound of copper or a crude oil, barrel of crude oil. But with a stock, it's just so emotionally invested, and you're always second-guessing yourself.
Yeah, and throughout the initial stages, you go through the herd mentality. So if you're not knowledgeable enough and, you're questioning yourself around certain decisions, you always like to hear what someone else has to say. And you go on your hot copper forums, and you go on different forums, and you read what other people have to say. And obviously these individuals are heavily involved or within the stock, and they got, quite a large sums of money in it. So obviously everyone's intention is for that share price to continue heading higher. But unfortunately, that's not the case. The market doesn't move up in a straight line. Sometimes it goes zigzag. Sometimes it comes back before it takes the next leg up. And these things need to be considered when you're making those decisions.
Do you think it's fair to say that you could potentially fall in love with a large stock? For example, a Coca-Cola and Amex, your Warren Buffett style. But if you find yourself falling in love with something that's micro or mini, it's a bit of a warning sign?
Well, if you're looking from the risk perspective, I would tend to agree with you because, falling in love with Woodside or BHP, it's, for those companies to go under, it's probably very, very unlikely, as opposed to a penny stock that does a lot of capital raising, that doesn't have funds to support their actions and journey. So from that point of view, absolutely. But even if you're trading the top 10 or 20 stock on the exchange, that doesn't mean that you're going to do it profitably. So you have to find a way and strategy to completely remove yourself from the emotion of it and utilize that and consider it just like a job.
So maybe fall in love, but not blind love.
Correct.
So when you had those losses, did you ever consider quitting? Have you ever had periods where you've left the market, not traded, and then come back? What's been that journey for you?
Yeah, that was definitely on my horizon and in my head, like I was about to give up. I think the most interesting thing was when I was so certain and so sure that that stock will make an announcement and it's going to continue heading higher, reverse happened, which emotionally impacted me greatly and financially as well. I actually haven't slept all night, and I write exactly how I feel and what my emotions are feeling at that point in time. And I literally said to myself, if I'm going to commit to this, then I got to do either properly or I got to give up. And the next thing was looking for an educational course and then gaining the knowledge, reading the books, and just basically getting equipped with the tools that will support me to successfully trade the financial markets. And I never looked back.
What are some of the mistakes or some of the things that you think that individual trader that's not in a corporate environment makes?
I'd probably focus on 3 key components. Number 1 is obviously risk and management. That's an absolute key.
What do you mean by risk management?
So what I mean is before you enter a trade, you know exactly what you're willing to risk. in case the trade goes against you. Contrary to that as well, you need to know exactly what is your exit point.
Okay.
What I feel like and what I've seen over the years, including myself in early days, is a lot of times you can actually enter the market, but a lot of times you can't actually exit the market. And I'm referring to a number of things. It can be liquidity of the market. It can be position going against you. It can be emotionally getting involved in a trade. So these are the all components that you need to take into consideration. Number two, I think the super important thing is, what is your trading plan and what is your edge? You have to have an edge in the market. And we can dig into a little bit deeper. And last one, which is probably the most important one, is your psychology. I've seen average strategies out there with traders and clients and individuals, but they've got a really, really good psychology. And having a good psychology to manage your risk and manage your trades and not emotionally get attached to your trades is the difference between being a great trader and an average trader.
Nassim Taleb, who's a very well-known trader, author, has a very famous saying. He says, the market is like a big theater with a small door, with a small exit door. And the sucker focuses on the size of the theater, whereas the smart trader focuses on the size on the size of the door. Because when things turn, you want to be able to not just enter a position, but get out of a position.
Correct.
Right? And that goes to what you're saying: psychology, planning, risk mitigation, all those things before you enter to kind of know how you're going to exit. How have you practically implemented? Give us some examples of how you've used those in trades that have been successful for you, or if in trades that weren't successful, but they helped you form that plan.
We can talk until tomorrow on this because there's been so many learning curves and so many challenges over the years. But I love using this analogy: plan the trade, trade the plan. That's an absolute key. And it's probably so complex and so hard for individuals to actually do because it requires a lot of discipline. I'm a big fan of scaling into the trades and then scaling out. So if I've got a profitable trade that's going my way and it's there is a certain percentage that it's in profit, I generally tend to protect my downside by moving the stop loss to the break-even position. If that position is got a lot more upside to go into, then instead of taking some money off the table and cutting my profits short, I actually scale in and top up those positions.
Okay, we'll put a bow on that and let's break it down further. So what you're saying is basically you don't just commit in 100%, you'll always scale in. That means potentially if you have an exposure, if your plan has told you that I can expose 100 units, for example, you won't go and buy those 100 straight away. You'll buy them in maybe blocks of 20 or 10 or 30.
Probably a little bit more. I'd probably say at least 50%.
So 50 in, leave the other 50.
Yes.
And then you'll assess to see if the trade has gone in your favor or against you.
Correct.
If it goes in your favor, you then readjust your stop loss. Is that what you're saying?
Absolutely. So I would move that to the break even. So in case the position does turn against me, I'm actually not in a losing trade anymore. I'm actually getting out, maybe paying a commission and paying a brokerage, but that's fine. I'm okay with that.
Yeah.
And then if I see a lot more upside on a trade, then I could be potentially scaling into those positions.
Got you.
And I've got an exit strategy. So if it's 100 pips or 50 pips, I would take some of those profits off the table and then try to milk and take advantage of the market going in my direction. The single biggest challenge that I see with traders every day is they cut their profits too short and they let their losses run. The reason for that is no one wants to be wrong, and it affects your psychology.
We don't like it, right? We all want to be right. We're in a culture, we go to school and the schooling system is designed to tell you that you're doing well. Everyone wants an A, not a D. But it's the D's and the C's that help us become A students in the future when it comes to markets, right? It's the losses, it's the lessons that help you go from not just scoring B's and C's, but A's and A pluses.
Correct, but that analogy is great, but that's only for those people that are willing to put in the work, effort, and time to actually commit to trading is not easy. I always say it is single one of the most challenging things that you can do, but it can be very, very rewarding if you're good at it. Because at the end of the day, you're either right or wrong. There's nothing in between. So your P&L, profit and loss statement, either reflects green or red, which is obviously making money or losing money. And I always keep saying as well, all your weaknesses as an individual are exposed through trading, because whether you're impulsive, whether you're emotional about the money, whether you're non-emotional, what's your relationship with money? What's your relationship with yourself as well? These are the components that come out when you're trading the financial markets, and that's why it is so challenging. But it is what makes a difference between someone that's actually really successful and someone that's not.
Do you think it's become easier or harder to trade with AI? And the reason why I ask that is because today you can sit down and ask AI to help you extrapolate all those things, right? What's my plan? What's my psychology around money? What's my risk tolerance? How long am I in for? Whereas 20 years ago, you kind of knew you had to do these things, but just doing them was difficult. It was difficult to build that discipline. Do you think AI makes it easier now or makes it even more competitive?
Well, it's a challenging question to answer because I'm a little bit biased personally. I'm a discretionary old school trader. What I'm seeing at Blueberry at the desk is I see a lot more clients moving towards that AI and EA, expert advisor trading or automated trading, because less and less people have time on their hands. They're busy with their work, with their family, with their with their lives outside of trading. So they want to automate the process. But not only that, automated trading keeps you away from the errors that you could potentially make or get your psychology involved. Because if you've got a sound and proof system that works really well, you can actually code that and you can stay away from watching the market every day and every night, right? So I think to answer your question, we're seeing a lot more of EA or expert advisor traders coming on board. Yeah. AI is helping with that sort of stuff, but not necessarily does actually work all the time. Again, it comes down to you and your preference. I'm more of an old school trader, position trader, looking throughout the charts and making assessments and decisions myself. But as there is more information out there, I'm sure it will evolve into the market and it will reflect into the market and psychology of the market, because we are actually seeing that markets are a lot quicker these days. There is a lot more volatility. There is more markets to trade as well. There is more available markets out there, and new generations will take that into account.
How do you use AI? So I know you've told me that you're more of an old school trader, but even the old school are using AI now, right? Like AI is just being embedded into everything that we do. How does an old school trader like you, who prefers to control the strategy, use new tools like AI, for example?
So AI for me is more so for the fundamental aspect. If I'm doing a lot of research on any particular company, I need the breakdown on the fundamental side of things. That's what I take into account. Otherwise, the research can take long periods of time. So that actually cuts and gives me a lot more flexibility, and it's much easier to actually comprehend and see everything on one page as opposed to go through whole heap of research from different broking houses. That's probably the only thing that I incorporate. Everything else, I still stick to the rules that I've been sticking for the past 10 or 15 years.
So the traditional hedge fund used to be the executors at the top, the portfolio managers, then a bunch of research analysts that would work under them, and then maybe a couple of people going and fundraising or managing investors. It sounds like in your own organizational chart, let's say as a trader, you've got the AI working as your research analysts, for example.
Yes.
But they're not going out there and executing on the trades.
No, I still make all the calls. I'm very particular how I actually like to execute and what I'm looking for in trades. And that's why I like to go through my normal process or routine, what I like to call, and make sure that I tick all the boxes before I enter the position.
We've spoken a lot about strategies, about our psychology, about all the fundamentals, but obviously there's a lot happening in markets. There's a lot happening geopolitically. There's a lot of volatility. There's a lot of uncertainty. One of the things you spoke about is so many instruments that we can trade now, but there's so much disparity across these instruments. How are you reading the markets at the moment?
Volatility is elevated at the moment. We've got the conflict in Middle East, which is causing a lot of disruptions across the globe, primarily in the oil market, which is probably likely to spread across different markets as well. And I think we're starting to see that in Australia with petrol prices as well. My core focus at the moment is to look at the bond market, treasury yields, have a look at what central banks are doing across the globe as well. and how the tune is changing at the moment. So, for example, in the US, we've actually seen, Jerome Powell and Fed pricing in 2 interest rate cuts this year. Now, all of a sudden, that mandate is actually starting to change because inflation is starting to pick up. We're seeing, headline inflation actually starting to creep up on the basis that crude oil is, appreciating in price, and the cost is actually much higher. That's likely to feed into the inflation overall and into the economy. As a result of that, we are likely to see goods and services increase, and everyday living is going to increase for every individual. And central banks will probably need to restrict the inflation. How will they do it? Well, by raising interest rates. Now, if they're raising interest rates, how does that affect currencies? How does that affect commodities? And how does that affect share market? So that's probably a broad-based structure that I'd be looking at the moment. And then I'd be digging into a little bit deeper, and I'd be like, okay, well, if US dollar is starting to move up, then what does it mean for gold and silver? And we've actually seen over the last couple of weeks, gold and silver have been coming off substantially. Many people don't understand why, but these are the reasons for doing so.
What do you think gold is selling off? What do you think other than US? I mean, the US dollar, okay, the US dollar is strengthening, but gold and silver have moved a lot more down over recent weeks than the dollar has, for example.
Yeah.
What's causing this sell-off in gold and silver?
Well, number one, we've had gold and silver appreciate over the last 2 years. So we've seen tremendous returns in gold and silver. At some point, central banks, hedge funds, institutional banks, traders will actually start to take some of that profit off the table. Yeah, that's number one. Number two, I think with central bank mandates changing as well, we are likely to, or at least in the short term, next 3 to 6 months, we're actually likely to see US dollar continue to head higher, especially if we don't get any interest rate cuts from the US. And I think a lot of people are going to start piling their money back into the US dollar, okay? Because whilst many will not agree, US dollar is still considered as a single most powerful currency in the world, right? And I think a lot of their money is actually flooding away from gold and silver, and it's actually getting repositioned into the US dollar as well. So these are probably the couple of reasons. I'm sure there's a lot more, but these are the 2 reasons that I'm looking at as well. On the back of that, treasury yields are starting to creep up as well, which means that market is providing a signal to, bond market is providing a signal to the financial markets that obviously the tide is changing. And as a result of that, we're actually seeing global equities starting to come off as well.
One of the things I like about how you think is, again, we spoke about macro and you start at the top. So we've started off at the top, which is the US dollar, bond yields. Then we're talking about the big currencies like gold, for example. Before we drill down and get into the next layer, where do you see your outlook for gold this year?
So I think for the first part of the year, we're still likely to see a little bit more downside. My key levels, if I'm going based on the technicals again, are around 4,000. That's my ultimate key support level. If we break that, then we are likely to go anywhere around 3,300 to 3,400. But even if we do see a comeback to those levels, I think it will be very short-lived because there will be a lot of liquidity coming into the market and a lot of central banks and hedge funds and institutional money coming through. So I'm still actually quite bullish on gold and silver long-term.
Both equally or one more than the other?
I would probably say equally because what we've seen lately is gold had a stellar run over the last couple of years. And then that run actually started to wear off a little bit. And then in nominal terms, silver was actually a lot cheaper. And we've actually seen a cross-correlation where a lot of the flow from gold actually went into silver. And that's why we've seen such an explosive move in the market. Okay. Because at the end of the day, as an investor or trader, you're always looking for something undervalued, which is going to give you a greater percentage or return on your investment.
What about copper? Where does that sit for you? Because we refer to copper as Dr. Copper. It's one of the greatest indicators of global demand. But copper is also found in gold and silver ore. So a lot of gold and silver mining, copper is sometimes a byproduct. How do you see copper? Is that a number 3 for you, or does it not sit on your radar?
It does. I'm generally quite bullish on commodities.
Across the board?
Across the board, that's right. And especially if you're focusing in Australia as well, because we're a commodity currency, we're a commodity country, we do exponential amount of exporting when it comes to commodities, and obviously reflects into our share market as well. Some of the biggest companies such as BHP, Rio Tinto, etc., have the biggest market caps on our exchange on ASX. So I'm generally quite bullish on the commodities, and commodities tend to fluctuate and do exceptionally well in the later phases of the bullish markets, right? And I feel whilst ASX had some good returns over the last couple of years, we still actually lagged a lot.
Yes.
When you compare it to NASDAQ, especially Tech 7, when you have a look at it against S&P 500, Dow Jones, etc. So I feel in Australia, we still got a room for further upside. And I feel material sector and commodities will actually drive that next leg up before we potentially get a major pullback.
The reason why I ask is because traditionally, if we go back to our stock trading days, to get exposure to gold or silver or copper, you had to go and trade the individual miners. And then there was a lot of execution risk. They had to get their mining right. Sometimes they would hedge. They might not execute. They would raise money and dilute. But today you can go on a platform like Blueberries, for example, and trade the underlying in markets. You can go long, short, trade the spreads. And so that's why I'm really intrigued, because what you're saying is commodities as a basket, you're generally bullish on.
Correct. Yeah. And I mean, just as you reflected now with Blueberry as well, the great thing is, like I always keep saying analogies, markets go up in stairs, they come down in elevator.
That's right.
So you can actually take the advantage of the both sides. And as an investor, trader, or experienced trader, that is definitely something that you need to consider when trading.
I'm going to ask you a personal question. One of my old bosses used to refer to Australia as the Saudi Arabia of the Pacific. And the analogy was that we really are a commodities superpower. Saudi Arabia obviously being energy and oil dominance, but Australia having more diversity. We've got gas, liquefied natural gas, which we export into Asia. We have coal, we have iron ore. We've got some of the best gold and copper mines and prospects also. Growing up in a country where you've seen war and conflict, and you being a refugee coming to Australia, how much do you think Australia benefits over the next decade from the obvious war that's happening now in the Gulf and the Middle East, as becoming a lot more attractive as a destination to invest?
It's a great question. I feel like this is a lucky country, and hopefully forever it will be. I think we've got a great standard of living here and freedom. I generally think Australia is a great place to invest. I definitely do. I'm not going to comment on the political front because, and governments, because I tend to disagree with a lot of things they're doing. And I actually genuinely feel such a wealthy country with so many resources, we are probably nowhere near where we should be, right? If you compare it to other countries. I was speaking to a client the other day who came, from the Middle East, and told me that, individuals in Qatar and some of these countries actually don't have to work. They still earn an income, which is provided by the government. Now imagine that being in Australia. I'm not saying that's how it should be, but I'm saying that, that's why you have low crime, low poverty in these countries, and people are generally tend to be a lot happier and do quite well. So I still feel Australia is a place to invest. I still think we've got fundamentally amazing companies, our corporate governments, and is phenomenal as well. So I always think we are, AAA grade country that foreign investment will come into. To answer your question, we export a lot of gas and a lot of these energy products out there. Yet, we have one of the most expensive electricity or gas bills, in the world. So that obviously tends to, I guess, paint a lot of picture and show, where we could improve and do things a lot better. But if you have a look at the, companies like Santos, if you have a look at the Woodside, they've been doing exceptionally well over the past few weeks. Like, Woodside and Santos have been 13 to 15% up since this conflict started in the Middle East. I'm sure a lot of that is actually a foreign investment that's coming through, and foreign fund managers that are actually buying the stock, because it is good. It's got a lot of qualities.
Yeah, we've got no Strait of Hormuz to worry about, and if anything, we're positioned on the doorstep of Asia,
correct?
Which is the economic growth engine of the world now.
Yes.
So I think Australia. You touched on a few individual stocks. We're now drilling down using your methodology of going top down. You spoke about energy stocks, for example. Are there any other sectors or stocks that you're excited about in this market? For example, electrification of cars, now that we've had the oil shock, anything in the tech space that you're liking at the moment that are on your top of your trading list?
Yeah, I would be focusing on the materials sector. I still feel we haven't actually seen the bottom of it, as I mentioned previously. So if I'm looking for a long-term portfolio, I'd be looking at stocks like BHP, Rio Tinto, and some of those big ones that provide good liquidity to get in, get out. They're generally very profitable companies. Fundamentally, they're very sound. They got great exposure amongst different sectors as well, and I feel there is actually a lot more upside for it as well. So if you go through the technical charts of many of these companies, a lot of them haven't actually made an all-time highs at the moment, as opposed to, let's say, banks. If you have a look at the top 4 banks in Australia, they pinned at all-time high a few weeks ago, and they've already done the retracement and the pullback. I would also consider doing some of the banks as well. I think for a longer term portfolio as well, because I feel with interest rates rising in Australia and likely to do so by RBA, the net profit margins will also increase as well. So I feel there is another squeeze there. And also I'd be probably looking at some of the stuff in energy such as Woodside, Santos, because I still feel that over the next 6 to 12 months, there is a lot more upside. If I'm looking at more shorter term stuff, I'll focus a lot on the index markets, gold, silver, and Aussie USD. That's an interesting one for me at the moment.
Let's move to our closing remarks. We're also going to wrap up after this with a question that we've got from a viewer. So keep your questions coming in. If you have questions, if you want to ask our guests what they think about something that they've discussed, we're opening it up to you. Regardless of where you're watching this, drop your message and let us know for future episodes, and we will come back to them. Before we get to the question, for someone that's watched this and maybe feels a little bit overwhelmed at the moment, what's your quick advice?
Education. Formulating a plan, and trading that plan. But I would probably say, don't be discouraged by early signs of, disparity or losses in the market, but because that's part of the learning curve. I think we've touched that initially. I've gone through it for first couple of years as well. And then once you get some solid education, you got to formulate a plan and you got to follow that plan. Now, one strategy doesn't fit all. It comes down to your personal type, because I've seen it even with Blueberry as well, where, different people might be using very similar strategies, and not all of them are actually profitable, because what works for you might not work for me. And then in the end, you got to forever evolve and change that and continue improving that trading strategy, because markets don't move, markets change, so does technology, and what works today might not work tomorrow.
And last question before we go to our viewer question, what's something that people should absolutely not be doing at the moment? Your biggest no-no that you have?
Biggest no-no is letting your losses run to blow up your accounts or make exponential amount of losses, like in terms of monetary losses. So I think that actually hurts, doesn't make you a better trader, and also puts a worm in your head and obviously plays with your confidence. And a lot of people actually give up throughout those days. So I think as opposed to today, you should be looking at what's my upside, what am I willing to take off the table, what do I feel comfortable with, and also what am I willing to lose. Because you have to understand that over the years that I've seen in financial markets, I've never ever seen a single person that's got a 100% strike rate when it comes to trading. It's more so 50-50, 40-60, 30-70, but it's understanding your plan, following that plan, and making sure that at the end of the month or at the end of the year, you got a healthy return in your portfolio.
Love it. Simple advice. Don't lose money. Have your plan. Stick to it. We're now going to go to our viewer question. Right, Matt, who's one of our followers, asks, at what point do you adjust the strategy versus accept drawdown as part of the system? We just spoke about that, right? And you just said don't lose money. But how do you manage what he's trying to say? Like, what, for example, is a big enough target for a loss? Like, you can't win everything, and you're saying don't lose. So I think what he's trying to get at is, how much do I lose, and at what point can I adjust that from a 5% loss to a 7% loss, for example?
it again comes down to your risk profile as well. I mean, what are you playing with in the monetary terms as well? What is the overall portfolio? At what point in time you actually don't feel comfortable in your strategy anymore? Is it, by losing 2% of your portfolio for the next 3 trades, or is it actually having next 10 or 15 trades that are actually non-profitable and they're actually losses? At some point, you got to make a call and think, okay, hang on, something is not working here. It was working 3 months ago. It was working 6 months ago. It was a similar market. Things were very similar. My entries were good. My exit was good. I was making money. Things were in my favor. But something has shifted. And this can be a fundamental shift as well in the underlying market, the way that particular stock, currency, commodity actually moves in general, because it could be sideways market, it could be range trading market. So these are all things that you actually need to consider and make a conclusion whether it is working for you or not.
What's yours, for example, if you don't mind sharing?
Yeah.
Or someone like you, what do you set as your maximum loss as an overall representation of your portfolio, for example?
Yeah. So generally speaking, 1 to 2% is what everyone preaches about. I tend to actually have be a little bit more flexible on it, because I do know that every time I enter the market, I might not be right. It might not go in my direction. Sometimes the entry is going to be good, but the market still might try to actually do a bit of a pullback before it can reverse and continue heading in the direction that I wanted to go to. So I tend to go around 5%. So if I've got $100,000 account that I'm playing with, I'm willing to risk 5% or $5,000 per each trade. But then I'm looking for the 7 to 10% return on that.
Yeah.
And then it's about managing and executing the trade, as I mentioned previously, and scaling in, scaling out to make sure I get to that position. The other one is don't overtrade as well. Like I know a lot of people do. Revenge trading, trying to come back and punish the market. That might not work. Like I always say, markets might be there or they will be there forever, but you may not as a trader. And you have to take that very seriously.
So Matt, I think the advice there for you is that you can potentially start off with a tolerance of 1, 2, 3%. But as you trade more, as you get more comfortable with your style and strategy, you can look at potentially increasing that. However, it needs to be systematic. It needs to have downside management. And if you're scaling in and out of positions, it's always a lot easier. Thanks so much for joining us today. Great to get your insights. Any final words or any final message to our viewers watching this?
Don't give up. Be persistent. It's not an easy journey, but it can be a very rewarding journey as well. To be a really good trader, it can take quite a bit of time. At least I would say probably 3 to 5 years. You got to go through different phases of the market. Markets change all the time, but it's ever learning game. Continue to be persistent, and the results will come as an outcome at some point in time.
Awesome.
Thank you for having me.
No worries. Absolute pleasure. Thank you for sharing your insights. And thank you to you, our viewers. This is our first episode. We have a lot more in store for you, but we want to ask you for a favor. And that is to like, share, subscribe. Share this with someone that you think will benefit from it, because that's our purpose here. We want to give you the edge. We want this to be a two-way conversation. Let us know what you're thinking. Give us your comments. But the more you spread it, the more we can continue to do this. Thanks so much, and we look forward to seeing you in the next episode.
This podcast has been powered by Blueberry, a licensed CFD broker. For listeners based in Australia, Blueberry holds AFSL 535,887. You should read the PDS, Client Agreement, and FSG. For clients based elsewhere, Blueberry holds a full-service dealer license with the Mauritius FSC.